Hello there, this is James, and you're watching Tixee Live. In fact, you're watching Tixee Live from the home. And today we are going to cover the FOMC minutes. Because in my opinion, this is the big one this week. Okay, the UK CPI, which was a shocker when it came in this morning, was a big event. But I think, to be fair, the market has been waiting for this event more than any other event this week. And this, of course, is the FOMC minutes, which is just gigantic in many ways. And the reason why I've taken a great interest in this is because I tend to feel that the markets over the last couple of trading sessions, certainly last week in particular, have been kidding themselves, because we've seen a pretty strong, bull rally in the markets, which I consider a bear market rally, on the back of the fact that the CPI last week came in at 8.5%. Now, I think the reason why I take an interest, I think the markets are kidding themselves because they think on the back of the last interest rate decision a couple of weeks ago, and the monetary policy, which some people considered to be quite dovish, I think the market is forgetting how obsessed the Fed is with reducing interest rates, getting interest rates down to their target of 2%. This is why I'm asking the question, will these minutes burst the market's hope bubble? Because, like I say, it's been on a very much of a bull rally because the market seems to think because the inflation reading last week was lower, the Fed's going to be gentle with us or gentle with the market. And I don't think for a second the Fed is going to be gentle, because though that monetary policy statement and the press conference had elements of dovishness in it. What I mean by dovishness is that where they're a little bit not so aggressive, it had also a lot of aggressive stuff in it as well. So, and I'm adamant that they've been keep going on about their 2% target, hitting their 2% target. So yeah, this is why I'm going to be a great interest, because I really think this could be the turning point. The markets to lose that hope bubble and actually realize, take into account that the Fed is not going to be gentle. Now, obviously, the FOMC, just for those who are new to trading, stands for the Federal Open Market Committee. And the minutes, which we're talking about today, which we're going to watch today, are released by the Board of Governors of the Federal Reserve. And it indicates, this is why it's so important, it indicates possible future interest rate decisions, okay? And why does this matter to the market? Well, this matters to the market for several reasons. First of all, don't forget there is several committee members, and they all get together and they discuss the current economic situation of, say, the US economy. And then they're very smart people, obviously. And then they take a vote on how many basic points they should increase interest rates by. So it'd be interesting to see on the previous minutes how much of the split there was. How many people voted for 75 basic points? Because we know what they did. It happened 3 weeks ago. They voted for 75, but it'd be interesting to see if there's anybody in the committee who voted for maybe 50 or 25 or maybe even 100. So it'd be interesting to see that vote as well. So it'd be interesting because the last minutes, because don't forget, this is two decisions on back to back. They have voted for 75 basic point rate hikes. Okay, so it's two back to back. The last minutes showed us that there was one member who voted for 50. So it'll be interesting to see the split. The other reason why the minutes are so important, okay, is because it can indicate if the FOMC are in a hawkish time or a dovish time. What do I mean by that? Well, in a nutshell, basically, if it's hawkish, then they're aggressive. They talk about economic strength in the market, and they talk about raising interest rates aggressively. If they're dovish, then they discuss, or then they sort of, their tone in the minutes are a little bit more, well, let's be more data driven. If it's negative data coming through, maybe we need to lay off being too aggressive, that sort of thing. Okay, so this is what the minutes are going to give us a little bit of hint of. And bear in mind, it's an 11-page document, which I'm going to try and decipher live on air with you guys. And we'll decipher what it's trying to say to us. Now, in general, a hawkish tone can boost the US dollar, okay? Give the dollar strength, okay? Because then the market automatically assumes that if there's a hawkish tone, then the Fed in September will raise by 75 basis points or maybe even more, despite the fact the CPI fell to 8.5% last week, and they had a very good job number the week before, the NFP coming in at 528. Okay, so potentially hawkish could be strong to the dollar and bad for the markets. Why is bad for the markets? Because stuff like the S&P and the stocks would potentially come under pressure because they will think, okay, the Fed's going to be aggressive, and the markets just simply can't handle it. So that's the one thing, one outcome of these minutes. The other thing is, if it's dovish, as in the minutes are read as in indicating that they're going to be gentle with us, then we can see the opposite. We can see the dollar under pressure, and the markets get risk appetite, thinking that the Fed are not going to increase interest rates that aggressively. Now, the big question is, of course, is it going to be 50 basis points or 75 in September? Now, before, obviously, the CPI came in, there was general consensus, okay, that, it's coming. Oh, thank you. Oh, is it Catalin? Oh, man, my pleasure. Thank you for joining me. Thank you for coming along and watching this. Again, it's not data, which is, it's more of a report, but thank you so much for coming along. I really appreciate that. Thank you. So like I was saying, so if the big question is, like I say, they're going to do 50 and 75. Now the CME Fed Watch tool indicates that they think it's a 56.8% chance of a 75 basis point rate hike come September. It was a lot higher before the CPI came in. But anyway, I'm talking too much. We should be having the report right now. So let's have a look and see if they've released it already, if we can see it. And at the same time, let's have a quick look and see if there is a reaction in the market at the moment. Now, don't forget, this is a report. So I'm not talking about economic data coming out like the NFP, which is just a number, which is easy for the market to do an instant reaction. This is a report. Obviously, some big investment banks have certain computer solutions which can go through this report really quickly, work it all out. So we're not looking at instant reaction. Let's have a quick look. S&P at the moment, currently waiting. Let's have a quick go onto the Fed's website. Again, we're still waiting for this report to come out. Aha, now I've got it. It's just come out. Okay, I'm going to download it now. Okay, so a quick look, see if the market is doing anything. Because obviously the market's going to read the report too. So, okay, no dramatic movements. Gold is moved slightly, but nothing dramatic. Anyway, we've got the report now. Okay. Now, I'm not going to read all 12 pages to you. I'm not. But I'm going to try and decipher what roughly these minutes say. And whether or not I can pick up a tone is whether or not they're hawkish or dovish. And at the same time, I will be going back to look at the markets and see how the markets are reacting. Okay? So bear that in mind. You reckon they're still going to be aggressive? I think they are too, to be to be open with you. I think they are too. I think the market's fooling itself if they're not going to be aggressive. But anyway, let's have a quick look. Let's see if I can decipher, see what it is. So anyway, in attendance, we all know it's the full board. Jay Powell, Williams, Michael Barr, Michelle Bowman, who's became a bit more hawkish over the last couple of recent speeches. James Bullard, who we know is aggressive. He wants to get interest rates to 3.75% to 4% by the end of the year. So we know he's aggressive. Susan Collins, and she's a bit of a dove. Lisa Cook, Isa George, Philip Jensen. Yeah, so they had a full board. So let's have a quick look. Let's just try and decipher roughly what was said. Right, bear with me as I decide it's a big topic. It's very wordy, so bear with me. Okay, so right. Okay, so there is general consensus. Okay, what they're saying at the moment is that attending from the discussion of economic and financial situation through the end of Wednesday's session. They say that over the period of time, the measures continued suggest that inflation would return over time to the committee's 2% objective. So they say, okay, what they're doing at the moment, they 100% believe will get their target down to 2%. Okay, so they'll achieve their objective. Okay, now, certain events abroad, I think they're obviously talking about what are happening in Europe with the energy crisis, obviously the Ukraine-Russia thing. They say, regarding developments abroad, central banks are advancing foreign economies, quicken the pace of policy tightening in order to address above target inflation. So they're saying they're also monitoring what's happening abroad as well with their decisions. Does that mean they will take into account that the UK's inflation hit 10.1%? Okay. So they're taking that into account. Okay, here we go. This is important. The 75 basic point increase in the target range at the June meeting passed fully to the federal funds rate and over rates, although downward pressure on overnight security. Okay, right. Does it say this? What does it say about the split? What does it say about the split? This is a very good question. Thank you so much for joining and asking a question. If the previous hikes in interest rates did not abate inflation, why would the FOMC continue raising the rates? Well, their argument's going to be this. It was 9.1 previously. They got it down to 8.5%. When they haven't got it down, they put it down to 8.5%. But that's year. But my point was, and I agree with you on this. I agree on you on this. Those of you who watch me do my CPI watch along, the year on year dropped to 8.5%, but the core did not drop. Core came in at 5.9%. I know they expected it 6.1%, but 5.9%. What was it previous month? It was 5.9%. Difference between the core and the year on year. Year on year takes into account oil. Core doesn't. Core doesn't. So you are right with your question on that. You are, because it didn't affect the core. Now you can argue year on year the drop of 8.5 was down to petrol prices and down to oil falling. But yeah, the reason why I tend to think it's not affecting the core so much at the moment. It didn't rise like they thought it did. But the year on year is more down and generated by energy prices than it is. But that's a really good question, a really good point. The reason why I think, this is why I'm trying to delve into this now, the reason why I just think they're adamant to get it down to 2%. And reason why is because they think the labour market can handle it. They do have a robust labour market. And the NFP number is obviously underlined it, but a fantastic Fantastic question. Thank you. Really good. And thank you for coming. Really nice to see you. Thank you. So let's carry on with the report. This is brilliant, by the way. Thank you for questions, interaction. This is what we do it for. Okay, obviously, real good exports down in May. Yeah, okay, that's interesting. Right. Okay. This is like the members' view on the current conditions and economic outlook. In a discussion, economic conditions noted that recent indicators of spending. Sorry, I lost my screen for a second. Of spending and production have softened. So they're taking in economic data here. Okay. Nonetheless, job gains. Again, this is what I was saying. This is why they're pretty confident. Job gains have been robust in recent months, and unemployment rate has remained low. It came in at 3.5%, lower than anticipated. Inflation remained elevated, which we know. Supply and demand imbalances related to the pandemic, higher food and energy prices, and border price pressures. Recognize the Russia's war against Ukraine. Yeah, we know this. Okay, they said that the war is obviously putting a lot of the pressure on it. Okay, what else? Right. Okay, now this is an interesting statement. This is an interesting statement. Okay, remember this is a 12-page document, so I'm trying to pick little bits out which I think will be quite interesting. Right, the members noted the indicators of spending and production pointed to less underlying strength to economic activity than suggested by indicators of the labour market activity. So basically, what that statement is sort of indicating slightly, only slightly, I would say, is that though unemployment growth, they said in this statement here, with unemployment growth still strong, the weakening in spending data implied unusual large negativity readings on labour productivity growth for the year so far. Okay, so they're actually now, what they're slightly saying here is that, yeah, they've still got a big, strong labour market. They are taking note. They're taking note in production, the drop in production, and the drop in consumer spending. Don't forget, retail sales today came in at 0% today. It was supposed to come in at 0.1%. So they're beginning to take notice of things like this, other than the labour market. Let me just try and make this a bit longer because I'm a bit old. My eyes are going. Okay, that's easier. That's easier. What else do they say here? Okay, they also noticed that supply bottlenecks will continue to contribute to price pressures. There were, however, some signs of gradual improvement in supply situation. They're talking about the oil situation there. Let's have a quick look while I'm reading this to see if there's any action, if the market is done anything, because I say the market's reading it just like I am at the moment. So let's have a look, see if there's any activity at the market. Give me a second. Okay. Okay. Right, initial reactions. S&P is trading slightly lower at 0.42%, but nothing dramatic. Nasdaq slightly lower, negative 0.81%. Dow Jones negative 24. Let's have a quick look at some other things which is happening at the moment. Gold, slight negative 0.58%. Euro dollar trading 1.0187. Sterling, dollar Oh, this is the one. Dollar yen. Dollar yen. That is lower. That has dropped. This one has reacted. 134.98. So while the rest are digesting this, the dollar yen has dropped to 134.99. It's trading before the minutes came out around the 135.40 level. So obviously, we're seeing yen strength on the back of this. So let's go back to this and see if there is, because like I said, there is a little bit of dovishness in this, especially when they're saying they're taking into account other factors, not just relying on their backup or building them up with the labor market. They repeat themselves a lot. Okay, here's the line which they hidden away. Right, last meeting, and I'll read this out. Against this backdrop, all participants agreed that it was appropriate to raise the target range for the federal funds rate to 75 basic points at this meeting and to continue the process of reducing the Federal Reserve securities or holdings described as plans for reducing the size of Federal Reserve's balance. So they all agreed. They all agreed to do 75 basic points this time around. All agreed to do 75 basic points this time around. Don't forget, the last time they did the 75 in the previous meeting, one person wanted to do 50. So they all agreed this time. They all agreed this time. What's this bit? Give me a second. Okay. Okay, let me just try and read this and make sense of what they're trying to say on this bit. In light of elevated inflation and the upside risk to the outlook for inflation, participants remarked that moving to a restrictive stance of policy rate in the near term would also be appropriate. Not this time around. No. They said all members in the minutes said this. You're welcome. Thank you. Thank you for joining. Thank you for joining. Look. Right, bear with me. My laptop's a little slow. I just wanted to decipher this bit. Okay, so I can't get these bullet points. But anyway. Okay. In a nutshell, it's going to take a little while longer for the market to digest this. Okay, but in a nutshell, the market currently is reading this as pretty dovish, because basically, though the Fed have said in their minutes they anticipate further rate hikes, it is more data driven. Don't forget, they actually mentioned retail sales or sales, and they mentioned the slowdown in industrial, not just the job market, which has been backing them up for the last couple of months. So they started talking about that. They underlined they're going to be more data dependent, and they are more likely to appropriately slow tightening pace at some point, not straight away, but at some point. So basically, there's no mention of the pivot, but in a nutshell, the market is currently reading this report as dovish, So as we stand, let's have a quick look at the dollar yen. Yeah, it is under pressure, 134.92. Euro is now up, higher, currently trading 1.19. The sterling, the cable, is still slightly negative, but slightly up. Let's have a look. More importantly, let's have a look, see how the market is taking this. Okay, the market's still digesting it. The S&P still trading around 4,289 points. Nasdaq still around 13,540 points. There we go, Dow Jones, 34,090 points. So as it stands for the moment, the market is reading this as dovish. But they did this with a monetary statement, which I think was a mistake. Okay, yes, they have admitted, and they did talk about the slowdown in sales and the slowdown in industrial production. That is true, they did. Retail sales came today is like 0%. Okay, it's an interesting question. Can I ask if the report is dovish? Why is the right? No, because this is the minutes are now reporting what they're might potentially do next. They did 75 last meeting they did 75 the meeting before. They may not do 75 next time, because now basically what these minutes are saying is they're saying they may look at other data other than the job market. Before that, all they were saying was they had a robust job market. Now they're looking at something else. They're looking at sales and industrial production. And yes, retail sales came in at 0 today, so that was negative. So this is why. Don't forget, they made a decision at 75 3 weeks ago. These are the minutes following that meeting about what they might do next. So this is why we're looking at it. But good question. Good question. Very good question. Is there any other questions, by the way? What does everybody else think about this? What does everybody else think? No problem. My absolute pleasure. No problem at all. Is there any other questions at all? Anybody else want to say hello? I know this is a very unorthodox tixee live. We're at my home, and we're not in my studio because it was a late night event. And again, it's a report. It's not data which comes out and instantly moves the market, which I know, but I still think this is a key event which I wanted to share with you and talk to you about. But like I say, at the moment, like I say, the market is taking this as a dovish report, or as a dovish minutes. Yes. So, so yeah, the wording's there to paint it as pretty dovish. But let's see how the market takes it tomorrow when we have a chance. Like I say, this is a 12-page document, so it might take a while for the market to digest it and read it through properly. So yeah, let's see. Like I said. Yeah, so basically, I'm just going to wrap this up with this statement. The commitments assessment will take into account a wide range of information, including public health, labor market conditions, inflation pressures, inflation expectations, financial and international developments. So from now on, they're not going to use the shield or the defense mechanism of the labor market. They're going to take everything into account. And so it was voted by all of them. There was none voting against it to this action. Okay, let's see what happens. Let's see what happens. Anyway, let's have a quick look. That's a good question. Dollar yen is still under pressure. It's still a good question. They're still at 134.92.7. Like I say, yeah, the dollar yen is still under pressure. Like I say, it was trading at 135.40 before this, so it's obviously digesting it. Before that, the dollar was on a bull run, so yes, still under pressure. S&P, everything is still digesting it. But yeah, we need to see what happens from tomorrow onwards. Brilliant. Is there any other questions or anything else anyone would like to say or talk to me about? No? What I will say though is thank you so much, everybody, for for coming along and joining me. I know it's really strange version of tixee Live, like I said, because it was late. I wanted to do it. I had to do it from home, so I could share it with you people. And I know it's not like the CPI or NFP, but it's still something which is really interesting to talk about and have an open conversation about. So I appreciate everybody. Big shout out to Catlin, SMF 790. Thank God, Shanique, which I thought was a brilliant question, by the way. Really good. Mr. Jonathan, thank you for your nice comments as well. And yeah, everybody, not just those who interacted, but everybody who's come along today to share this little experience with me. I really, really, really appreciate it. Don't forget, I'm back online again tomorrow at 8 a.m. UTC. 8 a.m. UTC. Then we should really be able to see how the markets digest this. Initial impressions, obviously, is they're thinking it's dovish. Only because I said they were taking into account other data. But anyway, yeah, it is first read a little bit dovish, so we have to see how that is. So I'm back on tomorrow at 8 a.m. UTC. Then again, of course, tomorrow at 2 p.m. UTC to cover the US session. We should really see then how the market is digesting this information and taking it in, which will be really fascinating. But anyway, till then, till next time. Don't forget, if you're watching me on Facebook and you enjoyed this little episode, by all means, give us a follow. And give us a follow if you want to. If you're watching me on YouTube and you like this little video, subscribe if you like. Hit the notification button so you know next time I'm going live. If you enjoyed this video and you found it useful and you put up with me, my over-the-top enthusiasm, give me one of these. See, I've got quite a few likes already, which I really appreciate, but it's always nice to know that you like what I do. But anyway, till next time, don't forget, these little videos are for educational purposes only, and in no way whatsoever should ever be taken as financial advice. I always suggest you do your own research, do your own due diligence, and of course, know the risks at hand before entering any trade. Till next time, every single one of you, trade safe.